Central bank role on price stability in UAE. Introduction. The primary function of a central bank is the maintenance of price stability. Central banks use monetary policies to control price stability. The intent of monetary policies is the creation of a stable environment for business. Economic development results due to the existence of a stable business environment. Price stability relates to inflation levels in a country. On the other hand, economic development relates to an improvement in the socio-economic conditions of a country. The United Arab Emirates, UAE's central bank used monetary policies to attain price stability and economic development. The UAE experienced unprecedented economic growth in 2010. During this period, the inflation levels in UAE remained remarkably low. Additionally, monetary aggregates slowed down, and the foreign assets of the United Arab Emirates central bank increased. Thus, price levels in UAE were stable and economic development occurred. This paper provides an outline for research on the role of the United Arab Emirates central bank in the fulfillment of price stability and economic development in 2010. Research questions. The central research question in the research involves the determination of the inflation rate that maximizes or promotes economic development. A central bank has to determine an inflation rate that enables price stability. Through price stability, economic development is attained. Consequently, the research seeks to determine the role that the central bank plays in the determination of the right inflation rate. The research has to examine the relationship that exists between price stability and economic development. Therefore, the research will determine the association between price stability and the real sector in UAE in 2010. Additionally, the research will examine the mechanism of monetary policy's transformation into real variables like price stability and economic development. Finally, the research will seek to determine the contribution that the real sectors, oil and non-oil sectors, make in the creation of price stability and economic development in the UAE. Problem statement. The problem statement of the research is the determination of the role that the United Arab Emirates central bank plays in the attainment of price stability and economic development. The research will focus on the year 2010. Statistical methods. The research will use a secondary data collection method. Data to be used in the research is obtainable from the Central Bank, World Bank, International Monetary Fund, and other organizations. Data stored by these organizations will be obtained through the Internet. The key data to be obtained by the research include United Arab Emirates commercial banks credit rates, the gross domestic product of UAE in 2010, the deposit and loan rates in UAE, the inflation rates of UAE, monthly, quarterly and yearly, the business confidence index in UAE, world development indicators, population growth, investments, and per capita incomes in UAE. Literature review. Inflation results in a decrease in the future productivity of investment, especially if price unpredictability accompanies it. Furthermore, inflation affects negatively the global competitiveness of a nation. It makes exports of a country expensive. In turn, the balance of payment problems arise. Thus, high inflation rates result in price instabilities and low economic development. The general belief is that inflation and economic development are negatively related. However, the relationship between price stability or inflation and economic development can be positive or negative. The central bank has to determine a rate that results in positive outcomes in the economy. A positive relationship between inflation and development can be determined through a classical model of growth. Through the model, it is possible to show that an increased inflation rate can make economic agents move wealth toward capital investments. On the other hand, Stockman showed the existence of a negative relationship between inflation and development by the cash-in-advance model. The role played by macroeconomic doubts in the reduction of productivity and investment reinforces Stockman's arguments. The model shows that a developed financial sector enables high capital creation and results in improved capital distribution. Additionally, past studies on the relationship between inflation and development have focused on the threshold effects that inflation has on economic development. There is a belief that an inflation threshold exists below which inflation has a negative impact on development and above which inflation has a positive effect on development. Hodges determined a negative relationship between inflation and development over a long-run period in South Africa. Furthermore, the study by Hodges concluded that countries that maintained low inflation levels achieved higher rates of economic progress. Thus, the literature confirms the negative relationship between inflation and economic development. The available literature further confirms the existence of an inflation threshold effect on development. However, most of these studies are cross-country analyses. Additionally, these studies do not provide information about the determination of inflation levels that enable development. Therefore, a gap exists in knowledge. This study will differ from past studies on the relationship between inflation and development. It will find the role that a central bank plays in the determination of an inflation rate that enables economic development. It is an attractive study as it focuses on a single country and a country that is rich in oil.